What if I told you that you could make money in the crypto market whether Bitcoin goes to million or crashes to zero? No, this isn't some get-rich-quick scam or a lucky guess on a meme coin. It's a professional trading strategy used by hedge funds called cash and carry arbitrage. And look, before we start, I'm not here to sell you anything. No courses, no paid alpha groups, nothing. I just want to show you a mechanism that actually works and, for some reason, almost nobody is talking about. It's not as flashy as 100 times leverage gambling, but it's how the big players actually stay profitable. Today, we're diving into the world of funding rates. I'm going to show you exactly how they work and, more importantly, how you can build a market-neutral position, meaning you have zero price risk while collecting passive income every 8 hours. Let's get into it. To understand the strategy, you first have to understand the funding rate. In the world of crypto, most people trade perpetual swaps. Unlike traditional futures, these contracts never expire. You can hold a long or short position forever. But there's a problem. How does the exchange make sure the price of the futures contract stays close to the actual spot price? The answer is the funding rate. Think of it as a balancing mechanism. When the market is bullish, everyone wants to long. This pushes the futures price higher than the spot price. To bring it back down, longs have to pay a fee to the shorts. When the market is bearish, everyone is shorting. This pushes the futures price below the spot price. In this case, shorts have to pay the longs. Most of the time in crypto, because everyone is naturally optimistic, the funding rate is positive. This means if you are short, the market is literally paying you just to keep your position open. And that is exactly where our opportunity lies. Now, you might be thinking, but if I open a short position to collect the fee, I'll lose money if the price goes up. And you'd be right, unless you hedge that position. In the next section, I'll show you the delta neutral setup, how we buy the asset on the spot market while simultaneously shorting it on the futures market to cancel out the price risk and harvest those fees safely. Alright, let's build the machine. To make this work, we need to create a delta neutral position. This is a fancy way of saying our total exposure to the market price is zero. Here is the step-by-step. Step 1. Buy the asset on spot. Let's say you have $10,000. You use $5,000 to buy BTC on the spot market. Step 2. Short the same amount on perpetuals. Simultaneously, you go to the Futures tab and open a 1x short position to short BTC. We aren't here to gamble, we are here to hedge. Look what happened. If Bitcoin goes up 10%, your spot profit is canceled out by your futures loss. If Bitcoin crashes 50%, your futures profit covers your spot loss. Your $10,000 is safe, it's parked. But because the funding rate is positive, the people who are long are now paying you a fee every 8 hours just to keep that short open. Let's talk numbers. A typical neutral funding rate is around 0.01% every 8 hours. That doesn't sound like much, right? But let's do the math. 0.01% per 8 hours equals 0.03% per day. 0.03% per day equals roughly 10.95% APR. That is 11% a year on a position that doesn't care if the market is crashing. During a bull market, these rates can spike to 0.05% or even 0.1% per cycle, pushing your yearly returns to 30%, 40%, or even 50%. You are essentially acting as the house in a casino full of over-leveraged traders. Now, before you go all in, there is no such thing as a risk-free trade. Here is what you need to watch out for. Liquidation risk. Even though you are hedged, your futures position uses collateral. If the price of Bitcoin rockets upward too fast, your short position could be liquidated before you have time to sell your spot. Always keep an eye on your margin ratio. Negative funding. In a brutal bear market, everyone wants to short. If the funding rate stays negative for a long time, you will be the one paying the longs. If that happens, it's time to close the strategy. Exchange risk. You are trusting the platform. If the exchange goes down, your hedge is useless. Stick to the big players. The cash and carry strategy is a staple for professional traders because it turns market volatility into a predictable yield. It's about working smarter, not harder. If you found this breakdown helpful, drop a like and let me know in the comments. Are you a degen long trader, or are you ready to start collecting those funding fees? Thanks for watching, and I'll see you in the next one.